Welcome. You're viewing the video version of the Pirls Stock Market Commentary featuring the proprietary bull-bear point and figure market breadth summary chart for April 3rd, 2016. Market breadth. With this past week's market rise, our bull-bear point and figure ratio at 1.75 rose from 1.46 last week, regaining some bullish territory. The total count of securities in bullish or bearish patterns increased 1% to 3,056. The count of bearish stocks decreased 9%, while the count of stocks in bullish patterns increased 8%. The Pirls PNF market breadth summary chart shows us a market now 4 weeks in bullish territory. Paid subscribers have access to the Open Office Calc data from which the chart is generated. You may become a paid subscriber by visiting s2pmarketsignal.com, clicking Membership, clicking Register, and following the prompts. To receive the weekly Pirls Stock Market Commentary via email free of charge, simply enter your email address in the space provided. The well-known market breadth indicator, the Nasdaq McClellan Summation Index, rose 64 points for the 21st advance in 31 weeks. At a positive 369.41 points, it has risen above the June 2014 top, continues above the November 2014 and February 2015 tops, and continues below the 3 additional tops above plus 100 and above all 6 bottoms below minus 100 in the last 3 years. Volume analysis. In this week's volume analysis, the Nasdaq Composite Index ended in accumulation mode with average daily volume higher than the prior week. In the last 2 weeks, the Nasdaq had 3 accumulation days and 1 distribution day. Accumulation days are counted when the index closes up on higher volume than the prior market day, while distribution days occur when the index closes down on volume higher than the prior market day. Last week, the Nasdaq ended in neither accumulation nor distribution mode on lower average daily volume. Momentum. Now at a positive 154.68. The CCI 20 daily rose from a positive 57.54 last week, continuing outside the plus or minus 50 range for a valid zero-line reject long entry signal. In Woody's CCI trading system, 6 consecutive bars above or below zero are required for a change of trend. The weekly CCI 20 of the Nasdaq Composite Index began a Woody's downtrend 7 weeks ago, while the daily CCI 20 began a Woody's uptrend 5 weeks ago. The CCI 20 weekly continues in a Woody's trend down. Now, with 2 consecutive weeks above zero, it rose last week to a positive 32.35 from a positive 4.90. Continuing within the plus or minus 50 range for a valid zero-line reject short entry signal if it falls next week. Industry rotation the last 2 weeks. All of the top 5 industries are positive, and all of the bottom 5 are negative. Bullish Comp Tech continues in the top 5. S&P Retail has entered the top 5. Oil Services continues in the bottom 5. Oil and gold and silver have entered the bottom 5. Disk drives, computer hardware, and brokers have left the bottom 5. Bearish, KBW Bank has entered the bottom 5. Semis has left the top 5. Focus this week. From www.zerohedge.com about that historic Q1 market rebound 24 of 26 massive snapback rallies occurred within a secular bear market. Short but highly significant, presented in its entirety below. Stocks should double in 3 years or drop by a third. In our April 1st chart of the day, we showed that the Dow Jones Industrial Average did something that it has only done 3 other times since 1900. After dropping over 10% during the quarter, it recovered to close the quarter positive. The 3 prior quarters that saw the Dow Jones accomplish this feat were the fourth quarter of 1933, the fourth quarter of 1971, and the fourth quarter of 2000. Following these reversals, the index had some interesting returns over the subsequent 3 years. It was up a lot, or it was down a lot. After the 1933 occurrence, the Dow Jones rallied as much as 98% over the next 3 years. Following the 1971 and 2000 events, the index dropped by as much as 35% and 33% in 3 years, respectively. So which will it be this time? The size of the deficit that stocks overcame in the first quarter may give us a clue. At its low, the Dow Jones was down minus 11.3% for the quarter. Looking at the prior reversals, we see that the Dow Jones max intra-quarter loss in Q4 1971 was minus 10.9%, and in Q4 2000 it was minus 10.1%. The max drawdown in Q4 1933 was minus 11.3%, exactly the same as this past quarter. Therefore, bulls can take heart in the fact that our prior circumstances are more similar to the 1933 event. And if history is to repeat, we should expect the Dow Jones to nearly double over the next 3 years to around 35,000. Of course, we can never be too sure, so we would recommend adjusting one's portfolio to take advantage of both potential scenarios. In all seriousness, one thing that may be instructive about such reversals is the overall investment climate in which they occur. The 3 prior events took place within secular bear markets. Additionally, there were 26 other quarters since 1900, which saw the Dow Jones recover at least 8% off its quarterly low after being down at least 10%. All but 2 of those quarters, Q4 1987 and Q4 1997, occurred within a secular bear market. Therefore, if there is anything that is to be gleaned from such large positive reversals, perhaps it is that they tend to occur within negative secular environments. Thank you for tuning in for this week's Sand to Pirls Stock Market Commentary, featuring the proprietary bull-bear point and figure market breadth summary chart, compiled by Donald Pearl, www.s2pmarketsignal.com. Hoping that you have been enjoying a peaceful and pleasant weekend, that you're looking forward to a prosperous and productive week coming up, and wishing you true success.